Hi, my name is Kevin Retscher, owner of First Meridian Mortgage, and today what I want to discuss is one of my favorite loans. It is the no-cost refinance. And I think it's highly important that you understand there is a formula to understand the no-cost refinance. There are many lenders out there that will do a refinance for someone and it'll be a no out of pocket, and the client thinks they're getting a no-cost refinance and they're not. And the lender is just rolling everything in the loan. So do not make the mistake of calling up a lender and saying, I want to refinance and I don't want to bring any money to the table. What you want to say in that instance is, I want a no-cost refinance and I'm willing to bring my escrows and a payment to the table, or I want to roll those in, but I still want a no-cost refinance, okay? So you need to understand the ability to actually check whether or not you're getting a no-cost refinance. On your loan estimate, you want to look in box J to see if there's a credit there that offsets your closing cost. That is one simple way on the documents to look at it. But I want you to understand the actual math behind a refinance, and we're going to go through that right now, and I think you'll find this interesting, okay? So the formula is payoff plus 1 month's payment plus the funding of the escrow account plus the closing cost equals your total obligation at closing. That's your total obligation. Then we subtract off lender credits, we subtract off your loan amount, and then you have cash at closing. So yes, there can be cash at closing on a no-cost refinance, okay? Bring that number over here, cash at closing. You get skip a payment, that's where you recoup this money. You get your escrows back from your current lender, that's where you should come back to even here, or fix any deficits that you may have in your escrow. The closing costs should be offset by the lender credit. Therefore, the loan amount should equal the original loan amount, which then means that you get a no-cost refinance. It's as simple as these two offset each other. These two offset each other. These two offset each other. The original loan amount should be the same, and you should have a no-cost refinance, okay? Now, that's how you cancel out some of the obligations. Let's get into some of the math, which does get a little bit more complicated. First, we have to discuss payoff, okay, and interest. Interest is paid in arrears on a mortgage. So when you make a June payment, that is really May's interest, okay? When you make an August payment, it's July's interest. So interest is in arrears. So let's make the assumption first, your mortgage payment on this loan is $4,000 a month. Let's make the assumption at the first of the month, after you've made your payment, so you're at $400,000. So you made your prior month's payment on the 1st. You're closing on this loan on the 15th. Interest is paid in arrears. Your payoff is your balance plus the interest to your closing date. So this is paid in arrears to the old lender, 15 days to the old lender. So if your payment is $4,000, we're going to say that you owe $2,000 to added, and your payoff is $402,000, okay? That's the first part of the equation. The next part of the equation is the new lender, okay? New lender is the only time you're ever going to prepay on your mortgage, and that's to get it to the first of the next month. So you're going to prepay these to the new lender, okay? And we're going to say that we saved some money on this, and we're going to say that that's $1,900. Okay, that $1,900 gets shifted over here into the prepaids for the escrow. So $1,900 in interest goes into the prepaids and the funding of the escrow. So new lender gets that. Then we have to look at escrows. Okay, mortgage companies are allowed a 2-month cushion. So if your taxes are paid twice a year, that means they're allowed up to a maximum of 8. Your insurance is a 12-month policy, maximum of 14. It all goes by due dates. So those may change depending on when they're due and where they're at in the cycle. But for this argument, we're going to say 8 months taxes is the max, 14 months insurance. We're going to equate 8 months taxes to be $4,000, and 12 months insurance we're going to say is $1,200. So in the escrow funding, we have $1,900, $4,000, and $1,200. That is $7,100. Okay, so we have 402, 7,100. Now we got to talk about closing costs. Closing costs vary based on jurisdiction and area, which title company you use. I personally have some pre-negotiated lower rates and costs with the title companies that I use, so I can try to save my clients money on their closing costs. Okay, so I'm just going to use that. The closing costs are roughly $4,500 in this particular scenario. Okay, so if we add those up, 402, 7,145, we're going to come up with 413, 600 as your total obligation, your TO. Okay, so this is your total obligation at closing. Then we take off your credits. Okay, so we're going to start taking off credits. We're going to first take off our lender credit. And how do we get a lender credit? Okay, this is going to be a quick class on interest rates. So everyone knows if you pay points, you get a lower interest rate. Then if you get a 0-point loan, then you only have to cover the closing costs. And then if you take a slightly higher rate, the lender technically pays you above par premium or points or negative points. Okay, so as an example, if 5 3/4 was paying a cost of 1 point, you would have to, if you took that, you'd have to pay a point plus closing costs. At 6%, no points, you would just pay the closing cost. At 6 1/8, they're giving you a credit of roughly a half of a point. Half a percent times the 400,000 would be $2,000. 6 1/4, they're paying 1 point. 6 3/8, they're paying 1 1/4. So in this particular situation, what we're looking for is the best deal that pays you the best credit to offset your closing costs. So let's assume that it's somewhere in the 6 1/4 to 6 3/8 range. We get a credit of $4,500 that matches our closing cost. Okay, I actually have a lender that I can specifically customize a credit to actually match closing cost. Okay, not all lenders will do that. Then we have minus the actual loan amount, $400,000, equals our cash to close. So if we do this math, we're at $9,100 due at closing. Okay, you're going to say, Kevin, this is supposed to be a no-cost refinance. Why am I bringing $9,100 to the closing table? This is cash flow. It's not cost. We offset the cost here by having a credit that matched the actual closing cost. Okay, we're going to bring this cash to close number down to here, and then we're going to skip a payment. That's $4,000. Then we're going to get our escrow refund back. Escrow refund is this portion, $5,200 roughly. Okay. At that point, we're positive the $100, the difference between the one payment and the $4,000, the $1,900 and the $2,000. That's $3,900 versus $4,000. Okay, so that equals a no-cost refinance. Okay, that is the math. Okay, there are a few more things to understand. Okay, one of those things is this escrow account will not be perfect. You could have more money in your escrow than what's needed. That's rare because when taxes increase, there's usually a delay in correcting that escrow. Your old lender would do an escrow analysis at some point. So if there was a deficit, it would catch up. When we do the new loan, they're going to use the new taxes and new insurance, so they could be a situation where your refund is slightly lower than what you put into your new account. But the benefit is your new account will be set up properly, and you're not going to have a double whammy increase when they do that escrow analysis. Okay, so couple things. Clients like to say, well, Kevin, should I do a no-cost refi if, in fact, I've already paid 2 years on my mortgage, right? So let's say this current mortgage that we had was at 7%, and we're in the 28th year, right? So you can do a few things. It's a pet peeve of mine to think that you go backwards. If you're doing a no-cost, and the interest rate you're getting is below what you currently have, there's no way you go backwards. Okay? Now, a few things. If you want to continue the same pace, set the new loan up for 28 years and just put the savings in your pocket. Okay? If you're super smart and you're worried about that scenario, not all lenders will let you do a 28-year. If they don't, you do the 30-year and you calculate out the payment so that you add whatever extra dollars that may be so that you pay it off in 28 years. If you're super smart, right? If you're comfortable with that payment, you continue to pay that payment on the new loan until you refinance again, and you might be paying it off at a 25-year pace with the savings versus at 6 1/4 or 6 3/8 versus 7. So term is a function of what you pay, right? And I've made $1 million in my life, more than $1 million in my life, understanding term is a function of what you pay. Even if they set it up for 30, you can pay more. So if you continue this 7% and rates continue to go down, you're not going to sit here and say, well, Kevin, should I refinance again? I paid $4,500. Well, in your case, you did a no-cost refi. You didn't pay the $4,500. So if rates continue to go down and you can get 5 3/4 now, which would have cost you a point if you were a fool and paid that, Now you can get 5 3/4 for free. You refinance again at no cost. And if you're super smart, you continue to pay that 7% because it was comfortable, right? And now you might be paying it off at a 20-year pace. And you were just paying what you originally were paying. There's nothing wrong with also just setting the term for whatever the new term would be at that time, taking that money and paying off another bill or investing for kids' college, things of that nature. So how you invest this money does matter, okay? If you took a 30-year mortgage, paid the minimum payments, this loan would have paid off in 28 years. Someone might say, oh, you got 2 extra years because you're refinanced. Keep in mind, before you make the statement that you went backwards, you have to tell me what you did with the savings for 28 years. Add that all up, subtract that remaining 2 years, and see if you came out ahead or behind. If you invested that money for 28 years, you're probably going to be ahead. Okay. A lot of people ask, how many times can I do a no-cost refi? Basically, you can do a no-cost refi every 6 months. And generally speaking, I would say it makes the most sense when you're saving at least 3/8% or more. Okay? On a $400,000 deal, 3/8% would be $1,500 a year. It's $100 a month. $100 a month can go a long way for the family. Okay? That is essentially the formula for a no-cost refinance. Now, a couple things. Beware of the guy that says in a refinance you can skip 2 payments. Here, no one really skipped 2 payments. 15 days went to the old, 15 days went to the new. You recouped it when the quasi-skipped payment came about. You just didn't mail out a payment here because you met your obligation at settlement. Okay? So keep in mind, if you end up not having a $400,000 loan when you started with a $400,000 loan, that's not a no-cost refi. Okay? The money due at closing, you should be able to subtract the payment, subtract what went into your escrow, and that should put you back to even. If you say, I want a no-cost refi, but I'm short on cash right now, so I don't want to do the refi, don't go with that process. Okay? And what I mean by that is borrow from yourself in that situation. This is where we still have all the math as a no-cost refi. You can roll this $9,100 into the $400,000 and still make it a no-cost refi. I'm going to show you that right here. So if you had 409,100, okay, and that would zero out this number here, cash at closing. When you skipped a payment, if you made that as a principal payment, and you got your escrow back for the $5,200, it's still a no-cost refi, even though I raised your loan amount to 409,100. Here's where the buyer beware comes into play. The guy that gives you this and doesn't give you that is rolling everything in and charging you closing costs. So if your balance was $413,600 instead of the $409, and this number down here was $4,600, then you did not get a no-cost refi. Okay? Now, there are times of the month, and especially with VA, got to be really careful out there on my veterans. There are a lot of people that will send out literature, skip 2 payments on a refinance. Okay. Again, you never actually skip 2 payments. Remember, you're going to pay it to the old or to the new one way or another. But I'm going to mess up the board just a little bit here and try to explain this. If you closed at the 6th of the month and you did not make this payment in the middle and you were at $400,000, you would owe 36 days back to the $400,000. So that would put, let's say, payment normally is $4,000, 6 days. We're just going to say $5,000. So the loan amount would be $405. And we're going to just say, for the sake of arguments, let's say you closed on the 10th so that the math will work. So 405. And then the new lender got their $3,000. So that then goes up into the prepaid section, and you didn't mail out a payment here, and you didn't mail out a payment here, but all these numbers are increased by $4,000. Okay? It still works out the same, because you would then skip 2 payments. This one and this one, if you in fact had to bring $13,100 to the table. So on a refinance, unless you're trying to get cash out, and here's the thing, the lender allows you to roll everything in. On Freddie Mac loans, you're allowed up to 1% of your loan amount cash back. Fannie Mae, you're only allowed $2,000. So you could actually roll in 2 payments, escrows, closing cost, either get a credit or not get a credit, and roll that all in and essentially skip 2 payments, get escrows back, and you would actually be pulling out about $14,000 and it not be considered a cash out. Now, who would want to do that? Let's say you have a bill that's been nagging you that you just want to get paid off, and it's a way to kind of throw in like one bill, okay? But in the end, keep in mind you want to understand the formula, okay? How often can you do a no-cost refi? As often as it makes sense. I've had clients from Freddie Mac that have done as many as 13 no-cost refis, never paid any closing costs whatsoever. They continued to pay their higher amount. When I first met the gentleman, he was like 8.25. 13 refis later, we'd got him down to all the way down to 1.99 on a 7-year fixed rate, and then he paid off his house. And he paid his house off a lot quicker than he ever would have had he not taken advantage of those no-cost refis. Okay. So again, just to recap, my name is Kevin Retscher, First Meridian Mortgage. I've been doing no-cost refis for approximately 30 years. I feel it's the only way to chase down the market using the bank's money by taking a slightly higher rate. Yes, taking a slightly higher rate in this scenario, if someone was at 7%, if 6 3/8 is below that, you're really not taking a higher rate, you're getting a lower rate, okay? You keep chasing this down until you think you're at the bottom. If you think you're at the bottom, if we get back down to the 2s, and you say, Kevin, I don't think that I'm going to have another opportunity to do a no-cost refi, and I want to pay the closing cost to get 1.99 because I'll never do it again, I'm not going to argue with you. But my rule normally is if we're not near all-time lows, or if I think that the direction of interest rates is going up, then I may say go ahead and pay closing cost. But in general, rates are usually cyclical about every 2 years or so. We broke that cycle with interest rates actually going up here recently, but we are starting to trend down. How far we go, I don't know, but I would feel more comfortable chasing the market down this way rather than paying $4,500. And if rates go down a little bit lower, you're going to say, well, Kevin, are they going to go lower? And if you're going to pay $4,500, you're going to care. If I'm giving it to you for free, you're going to say, sign me up, let's go and get it done, right? Again, my name is Kevin Retscher, First Meridian Mortgage, 703-799-5626. I am a veteran-owned business. I do a lot of VA loans also. This equation is the same for a VA loan, excluding whether or not you have to add in one other item, which would be your VA funding fee on an IRL, interest rate reduction refinance loan for a veteran. Now, the benefit of the veteran is he also does not have an appraisal, so his closing costs are cheaper and less documentation. Again, thank you for watching this video. Like, share, and subscribe. I appreciate it. Again, this is the formula for a no-cost refinance. Give you a chance to take a quick look at that, and then I want to break it down to where you can actually see what that formula is one more time. Payoff plus interest to the closing day, plus a month payment, plus the escrows, plus the closing cost, total obligation, minus the credits, lender credit, minus your loan amount, cash at closing. Cash at closing, you get to skip a mortgage payment, get your escrows refunded. You should have a no-cost refinance. In closing, I feel that the no-cost refi is the only way to chase the market down using slightly higher rates but lower rates than what you currently have, essentially using the bank's money to cover the closing cost. They're trying to recoup their money over a 30-year period. You're trying to recoup it from day one. Okay, so it's just a matter of what happens in the future, but if you're getting a lower rate and there's no out-of-pocket and no recoup time, there's no reason not to pull a trigger. If you're paying the closing costs, you're going to sit there and think, well, should I do it now or should I do it later? It takes the guessing game out of the market. There's no limit to the number of times that you can chase the market down by doing a no-cost refi. So therefore, I feel it's the best way to actually lower your interest rate. First Meridian Mortgage is licensed in Virginia, Maryland, DC. I would be happy to help you in those states. I also have a network of 32 other states covered with other like-minded mortgage broker owners just like myself. Happy to refer any of them to you. Just give me a call, text me, email me, however you want. I'll be happy to help. And to all the Marines out there, as I always say, Semper Fi. I'll talk to you soon.